Black Friday 1866, the fall of Overend Gurney and the birth of modern banking. 1. The fall of a giant. On May 10, 1866, the unthinkable happened. Overend Gurney and Company, the most trusted name in Victorian finance, collapsed in a single afternoon. Once the banker's banker, the firm had grown 3 times larger than its nearest rival and was considered safer than the Bank of England itself. But when depositors lined up outside the corner house and demanded their money, the vaults emptied within hours. By 3:30 p.m., the partners begged the Bank of England for a rescue. The answer was simple: no. Footnote. The refusal to save Overend Gurney marked a turning point. Size no longer guaranteed survival. 2. From boring to dangerous. Overend Gurney began conservatively. It specialized in discounting bills of exchange, steady, safe, and profitable. But after the death of Sam Gurney in 1856, the next generation abandoned dull stability for speculative glamour. They financed Greek railroads, Peruvian mines, Welsh ironworks, and shipyards that had never launched a vessel. The profits promised 30%, but the risks were catastrophic. Reputation lag kept the deposits flowing, but the firm had become a shadow bank before the term existed. Footnote. Reckless expansion turned a conservative institution into a speculative casino. 3. The IPO trap. By 1865, the partners knew the game was up. Their solution? Go public. They converted into a limited liability company and sold shares to an adoring public. The prospectus highlighted tradition and prudence, not failing shipyards and toxic loans. The IPO was 9 times oversubscribed. Insiders cashed out. Outsiders bought the myth. Within 9 months, those shares were worthless. Footnote. Limited liability protected insiders while small investors paid the price. 4. The panic spreads. The trigger came from small failures, a contractor in Wales, a provincial bank in Liverpool. Nerves frayed. By May 10, rumors turned to runs. After Overend Gurney's collapse, panic swept London. By May 11, Black Friday, banks failed, trade halted, and riots erupted. The contagion spread to Paris, Berlin, and New York. Within weeks, 200 companies failed. Unemployment spiked. The British Empire's rail expansion froze overnight. Footnote. A single firm's collapse cascaded into an international financial crisis. 5. Systemic change. The Bank of England, forced to suspend the Bank Charter Act, printed emergency money to stabilize markets. For the first time, it acted as a true lender of last resort. Yet it allowed Overend Gurney to fail, proving that systemic importance did not guarantee a bailout. The trials that followed produced no convictions: recklessness, yes; illegality, no. But the episode reshaped finance forever, cementing the Bank of England's regulatory authority. Footnote. The crisis birthed modern central banking and formalized the lender of last resort role. 6. Lessons for today. The patterns are timeless. Boring firms that chase excitement implode. Reputation lingers long after fundamentals rot. IPOs can be red flags for insiders escaping a sinking ship. Shadow banking always ends badly. Leverage and illiquid assets spell doom when confidence evaporates. In 1866, panic spread by word of mouth. In 2023, Silicon Valley Bank fell in 12 hours with a digital run. The wheel turns, the names change, but the script remains the same. Footnote. Human nature, greed, overreach, and misplaced trust, remains the constant in every collapse.